since money has been invented. We always lend money within family, friends, and colleagues. Now, using technology, we are able to lend to people whom we don't know. That's what this peer-to-peer lending platform is all about. It enables people who are saving to lend to people who need money rather than going through a financial institution. There are two ways one can look at it: how big it has become in the last 10 years and what is the further roadmap and why that is. So if we look at three big markets in China today, in 1 month they do $15 billion of peer-to-peer lending. In US, Lending Club now does $4 billion a quarter as a single company. And in UK, Funding Circle and Zopa are doing billions of pounds a quarter. And then finally, recently, a new company which is incorporated in New Zealand has done $100 million in 1 year. So that's how they're growing. The pace of growth is rapid. Two, what is the future? The future is two parts. One, people who are not getting access to credit, they're getting access to credit. And it doesn't mean that if I did not get access to credit from a banking, I'm bad. Are we all the most premier customer of a bank? No. Bank has different tiers. But when it takes money, it has programs for different tiers. But when it lends money, it just has one tier. You are in or you're out. And that depends on each of those financial institutions, what their strategy is. So sometimes, based on their strategy, a lot of people are left out or they do not know how to deal with them. And that's where peer-to-peer lending comes in. So that's one area of growth. The second area of growth are people migrating away from banks or financial institutions because it is cumbersome and it's easier to do online in the new technology. So that's the growth area. Putting a number, anybody's guess, but what we have seen today in US, UK, China, New Zealand, it's growing at 100% year on year. At the end of it, the basic is fulfilling the need for credit. But in a bank or a financial institution, they are taking a credit risk on the borrower. And that's why they get the return and the savers get 0%. In this marketplace, peer-to-peer lending, we bring borrowers and lenders together. So the lenders can earn interest, which is much higher rather than 0%, and the borrowers can save money and not pay 34% on a credit card to the banks. That's where this is a marriage of convenience, but there is risks involved, but it gives a better return. With no risk, there's 0% return for the savers and high cost for borrowers. But this is what I will call a shared economy, and when you share things, the cost comes down. When people are lending to anybody, they're lending to earn a return. When we are buying, and I'm going to take an analogy, we are buying a bond, or we're buying a stock, or we're buying a mutual fund. Do we know enough about any of them? No. We don't know what the management strategy is going to be as a retail investor. We just know HSBC is doing well, or some bank or stock is doing well, Apple is doing well. Do we know what the next product Apple is working on? We don't know. That's only available to institutional investors. So as a retail investor, we are anyway doing businesses with strangers. However, as I said, in a marketplace where lending is happening, while it is stranger, every marketplace shows the characteristics of the borrower. The name is not important, the characteristics are. So what's the age? How long has he been working? Does he have enough income? Does he have more debt than his income or less debt than his income? Can he repay? Has he displayed ability to repay back month on month based on his earlier debts, which is available from the credit bureau? Those are important information which helps you make judgment. And very simply put, if the interest rate is low, that means the risk is low. If interest rate is high, then the risk is high of non-payment. What one should do is diversify across the portfolio so that you earn your yield which you're looking for from a lender perspective. You can go to Lending Club website and download all the MIS of how the loans have performed from 2007 to 2015. So if they've given loans which have defaulted, you will not know the name, but you will know what the characteristics was. Now, can you get that kind of transparency in any environment? No. Everything is visible to everybody. It's online. So everybody can make their view by looking at it whether the platform is doing well, is it giving best interest to the lender as well as the best interest rate to the borrower. People think, how can a borrower be benefiting and the lender be benefiting at the same time? It's not, right? In the current financial system, the borrowers pay high and the lenders get low. The lenders are the people who are putting deposit. In this, it's transparent. If this guy is paying 7%, you're getting 7%. Surely you pay fees for the platform, but it's transparent. One is regulatory environment. The regulators are grappling with this change coming towards them. Surely they have the best interest to keep the consumers protected, but this is happening. So how do they grapple with it? How do they regulate it? And the second is customer trust. How do you build that customer trust? In an environment where there's no regulation, how as a company yourself put high standards such that you can still process transaction, still be truthful and build trust with consumer one at a time. Because right now, without any regulation, they always think, oh, am I doing something?